Good afternoon, everyone, and welcome to Libro's next edition of our webinar series. Today's topic is spousal income splitting. We were very encouraged to see the number of owners and potential owners, perhaps, that have joined us today for this topic. On behalf of my 800 Libro colleagues, I want to welcome you to today's webinar. My name is Paul McQueen. I'm the VP of Wealth, which is not a title I particularly like, but it really represents what we do with our owners, focused on our investing and financial planning offer. Very proud to be joined by Doug Carroll from our partners at Aviso Wealth today, and I'll introduce Doug shortly. I'm actually in Toronto today in a hotel representing Libro at the Responsible Investment Conference. We are a proud supporter of the Responsible Investment Association of Canada and our commitment to that and the environmental, social, governance, ESG factors going forward. As well, Libro is also a B Corp. We are committed to using our business as a purpose for good and to not just represent our owners and our shareholders, if you will, but also all stakeholders that engage with our organization. One of those commitments is the ongoing commitment to financial literacy, and today's topic should be supporting that. A few householding items, just so you're aware. For example, we can't see and hear you. You can only see and hear us, for better or worse, I guess. But please use the Q&A section if you do have a question for Doug on today's topic. Please feel free to put that in the chat, and we'll find some great spots to interrupt and bring that into the conversation. We have found that general questions work best. If we do have very specific personal questions, we'll do our best to make them applicable to the entire audience, and we can certainly always forward those directly to a coach or put you in touch with one of our coaches at Libro if you require help. And just a final note that today's recording will be available after the event on our website at libro.ca, as well as any relevant handouts will be included in our follow-up email. So a little bit about our guest speaker today, Doug Carroll. Doug is the tax and estate specialist for Aviso Wealth. Aviso Wealth is the wealth management dealer partner to credit unions across Canada. Doug has ran an estate planning law practice and was an advanced case consultant with both a life insurer and mutual fund company. Doug holds a business degree and a Master of Law specializing in tax, is qualified as a certified financial planning professional and a trust and estate practitioner. He's been doing this for over 25 years, supporting our financial advisors and our owners. He does a lot of different things, from writing articles to consulting with us on complex individual cases, and of course, webinars like today. So on that, I will turn it over to Doug and today's topic on spousal income splitting.
Okay, and just going to click my button so I can get my screen up in front of everyone here, and then I'll launch into it. Thank you, Paul, for the intro to everybody, and thanks everyone for joining in on things. By the way, I'm going to say I've got allergies, and this is a water bottle. I was on a call yesterday, and somebody thought I was vaping just because of the shape of the bottle. It's a water bottle, and so I'll be taking sips from time to time to clear my throat. So the topic that we're getting into here today is spousal income splitting, and it is not necessarily just about what you do with your investments. It goes a little bit beyond that, but a fair bit of what it is that I'll be touching on is directed at how you can manage your investment assets in a way that you can split income between spouses. So that's the idea that we're trying to get into when we're talking about income splitting. And I'll go through these topics, 10 topics that I'm speaking on. I don't think that I have any extras, but if I do, I have the odd extra slide in here, but it's pretty much this is our 10 topics. As Paul said, if you've got questions as we're going along, then please do pop them into the Q&A and Paul will flag me down. Otherwise, I'll continue through with things. If it's a question that maybe can be deferred to the end, then I'll leave it to Paul, obviously, to make that decision. If it's something which is critical in the moment, then I'm sure he'll stop me to deal with it as it comes up. So these are the topics that we'll touch on. I've got a fair number in this presentation. I got a fair number of visuals more so than text. Text to support it, but visuals to show the flow of things. A lot of the tax savings that you're going to get is by the title of the topic about splitting income that otherwise is taxable to one of the spouses into or over to the other spouse. And so it's useful to look at those visuals of arrows of the movement of these things. Fairly obvious in most cases, but it's nice to be able to see how it is that the taxes are being applied. Now, I am going to start with some just general comments about what you get from a tax or financial standpoint when you are a spouse. And when I say spouse, I'll just keep on saying spouse. Spouse being a legal married person, or two people who are legally married to one another. But for tax purposes, most, if not all, of what I'm going to say is equally applicable to those people who are in a common law relationship. So not legally married, but from a tax perspective, are considered to be a couple, and so get the benefit of being a couple. And I wouldn't necessarily call them drawbacks, although I'll shoot them up here in just a second, but some of the concessions may be a better word to apply to it that happens when you're a spouse. So in terms of the benefits of being a spouse, each of us individually does have the ability when we file our taxes to not have to pay tax on the first few $1,000s of income that we earn, both federally and provincially. There's a basic amount, a basic credit. And if you're a spouse and if you are not earning income, or if you're earning a limited amount of income, then you lose out on the non-taxation of that when you are a spouse. But the fact that you are a spouse with someone else means that the person who is filing taxes, or the higher tax income earner, is able to claim the spousal credit, which effectively allows for that basic personal amount credit to be used by the higher income spouse for both him or herself and for the other to reduce down the household's tax bill. The second item here, and these aren't in priority order, that's the core one about the spousal credit, but beyond that, second item that I've got here is the use of medical expenses to reduce down taxes. With medical expenses on an individual basis, it is based on your income. Once your income breaks through a certain income threshold, then the medical expenses that you may have in a year beyond that level allow for you to get a tax deduction, tax credit out of that, sorry. Actually, this is deduction. So the amounts that gets you beyond that level is on a per person basis, except when you're a spouse, then your two incomes can be used to calculate the level at which you are going to cross that threshold, and the expenses that the both of you have can be combined so that you will break through that threshold sooner in order to make use of that tax break. It's fairly substantial medical expenses you would be in a position for to be able to make use of that. Similarly, for charitable donations, there's a threshold, $200, where you get the lowest tax bracket break, and then you break over that and you get a high tax bracket break. With spouses, the two of you can combine your charitable donations for a given year and break through that $200 level much more quickly because you combine the two of you. You also have the ability to transfer certain tax credits between the two of you that, but otherwise, if the lower income person could not claim those credits because there's not enough income against which to apply those tax credits, then some of those tax credits, it's a small number of credits, but they can be transferred over from one to the other. One of those things has to do with tuition, for example. There are tax-free rollovers you can have between spouses, so you can transfer capital property that has a capital gain. It can be transferred from one to the other between the spouses and transfer over at its cost base without triggering the capital gain. It's automatic. If you want to trigger the capital gain, then you can do that, but the tax system automatically allows for you to have a rollover from one to the other. Hold on to that thought because it sounds like a great deal and you can get around all sorts of taxes just by giving from one to the other. but that's the initial transfer. The income off of that is treated a little bit differently. You also can create a trust for your spouse, whether you do that during your lifetime or through your will. And similarly, you can get rollovers to a trust for the other person, and not have tax applying on transferring into the trust, which you will have determined that it's helpful to have a trust in place to manage property for the other. And the last thing that I've got showing here as a as a positive benefit of being spouses is the rollovers that occur with registered plans, RSPs, that you can contribute into a spousal RSP for the other, and that upon the death of one of the two of you, then the plan can roll over to the other, not being taxed at that point, but being able to continue on tax sheltered in the survivor's hands. And then in terms of the potential drawbacks or concessions, boundaries, as I've got it here, there are a few things which, because you are spouses, you have to combine your income together, or you are treated in terms of the time that you're together in a little bit of a different way. Canada Child Benefit, you combine the two people's income together, and so the entitlement to the Canada Child Benefit, if you have significant income of the two of you, you'll break through that threshold where there might be some reduction. Principal residence exemption is shared between the two of you. Oh, Paul, you want to come in and touch on something before I continue on with that?
We're just trying to confirm if we're having a technical glitch behind the screen. Some of I'm still seeing the title slide, but other people are seeing now the benefits and boundaries slide. So we'll continue as if it's working normally. Doug, I apologize. I just wanted to make sure that the slides were advancing correctly.
Okay. All right. Well, I'll continue on with this one, and if need be, then I'll turn it off and turn it back on again. And you can just let me know, Paul, if it I don't know, because as I'm looking at it, I'm seeing the that benefits and boundaries slide. But come back on and let me know, and then I'll turn it off and on again. And you know, the classic, we Luddite people who aren't technicals, we turn them off and on and hope that that's everything you need to do to fix technical stuff. So principal residence exemption, that's one of the biggest tax benefits we have in our tax system, that the capital gain on a principal residence is not taxable. It's on a per person basis that it generally applies, but when you're spouses, you share that between the two of you. So you don't get to have two principal residence exemptions when you have two people. You do share that once you become spouses. With the RSP home buyers plan, there is limits that to the ability to make use of it, in that if your spouse has owned a property within the last 4 years, then you together will not qualify for the home buyers plan, although you have two of you that potentially, if you do qualify, get to use the $35,000 of withdrawal capability out of the RSP with the home buyers plan. So multiply that by 2, by whatever the amount is, could be up to $70,000. And then income attribution is what we're going to talk about in a large part as I'm going through the material here. So what income attribution means is where one person has given to the other property that it earns income, then the tax on that will be taxed back to the original person. So I'm moving on now and talking about RSPs and spousal RSPs. And we've got the figures up here, the current dollar figures that apply in 2023. The basic structure of an RSP is that you get to put money into an RSP based on your earned income, which is, for the most part, it's your employment income of the preceding year, determines how much new RSP room you gain in the coming year. So in the current year, in 2023, the reference point is what was your 2022 income, and 18% of that will give you RSP contribution room up to a legislated maximum figure, which currently is $30,780. So that's your 2022 income that you would get that full amount if you are somewhere. I just have to check down and see what the figure is, $171,000. So if you make over, or you made over 171 in 2022, the maximum you're going to get is $30,780. Plus, if you didn't use any of your previous room or some part of your previous contribution room, then that carries forward from year to year. So you get your new room plus your unused room, and you can use that either to go into your own RSP, or it can go into a spousal RSP. So you, as the person who has earned the income that has led to your own contribution room, can use it either to accumulate directly on your own behalf, or put it into that spousal RSP. And the idea with the spousal RSP is you are using up your own room to do that. So you get the tax deduction when you do that, but you're putting it in the hands of your spouse, who would be the annuitant, the owner of that plan. And then he or she would be taxable on the withdrawals from that plan, which, as is the general intent, will happen in your retirement years, or whether you don't want to call them retirement years or just later years, it will happen at the time when that money is drawn down. Now, in some cases, you might make a contribution into the plan, and then the annuitant spouse, the owner of the plan, takes a withdrawal earlier than at the point when you're into those retirement years. It might be at a point which is within 3 years of when the contribution is made. And in that case, if the withdrawal is made in the year of contribution or either of the next 2 calendar years, then the income on that is going to be taxed to, or the draw out of that is going to be taxed to the contributor. So if you do have a high income contributor and a lower income annuitant spouse, you had intended that you're shifting over that money to the lower income spouse, but within that window, that 3-year window, you're going to have taxation back to the contributor. So that's one of the things to keep an eye on when you're making spousal RSP contributions, particularly if you're getting down to your later years before you're going to have retirement happen, where you're going to actually knowingly be withdrawing that money to live on. Then you'll want to pay attention to when the contribution is made, and specifically where you're making contributions into a spousal RSP or even your own RSP. You can do that over the course of the year when you have the earnings, or you can do it in the first 60 days of the following year and still have it applied back to reduce down the taxes, take the deduction in the immediately preceding year. So if you make a contribution, let's say, in the first 60 days of 2023, you will have been able to use that contribution as a deduction against your 2022 income. But because you made that in 2023, the window that you would have attribution applying would be 2023, 2024, and 2025. Whereas if you had made the contribution before December 31st of last year, then likewise you'd get the deduction in 2022 against your 2022 income, but your 3-year time frame would be 2022, 23, and 24. So as of 2025, the annuitant spouse could take a withdrawal and not have attribution apply. So depending on how you're managing your money flows, it's something to keep an eye on. It might be something that, again, towards those later years, you make the contribution before you hit December 31st, and that gives you a little bit more flexibility then. Now, contributions into an RSP are only allowed up until December 31st of the year that you turn 71. However, if you are in that position where you are at or past the age 71 time period, you can make contributions into a spousal RSP if your spouse is under the age of 72. Effectively, you'll be able to make those contributions and still make use of your RSP room. Otherwise, once the two of you are past that point, then that unused RSP room will remain forever unused. So the last thing that I want to comment here about being spouses with RSP money, RSPs are registered retirement savings plans, accumulation vehicles for retirement savings. And then once you get to the point where you're going to draw those down, you can either take the money out directly, and that's taxable in the year that you do that. You can purchase a registered annuity that pays an annual amount thereafter, which will be taxable as is paid to you, or you can move that money over from the RSP over into a registered retirement income fund that has a minimum amount that must come out of it every year, and then you'll continue to make investment decisions about that money. You can make or you can transfer into a RIF and choose to have the minimum amount of withdrawals not based on your own age, but potentially on the age of a younger spouse. It's calculated based on your age, and your higher age means that a higher percentage must be pushed out to you, taken into income on a year-to-year basis. If you want a little bit more flexibility on not having to take out the mandatory amount or as large a mandatory amount, then what you can do is you can have the withdrawals based on a younger age spouse. So a nice benefit to being a spouse, to be able to use the age of the other. Now, beyond registered money, we also have the possibility, or beyond the use of spousal RSPs, we also have the possibility of using what's called the pension income splitting rules, which was introduced about 15 years ago. I think it's probably pretty commonly known for those people who are retirees already, who are drawing down off these funds. But if you're not yet at that point, then it might not be as familiar to you or familiar at all. The idea with it is that if you are a spouse, then when you receive eligible pension income during the course of the year, you are going to receive it yourself legally, but when you file your taxes, you are able to split up to 50% of the amount that you receive as eligible pension income over to your spouse. So you still receive it yourself during the course of the year, and then you decide when you do your tax filing the following April, or by the end of the following April to be on time, you decide for yourself, between you, whether and how much you want to split over to the other, and it is up to 50% of the amount that you receive. The difference between the two types of income or the two categories of income is based on you being either age 65 or under age 65. If you are under age 65, then the type of income that qualifies as eligible pension income for income splitting is money that comes from a registered pension plan. The other addition to that, less common but not completely unknown, obviously, would be if the money that you are receiving out of a RIF is coming to you because of a predeceased spouse. So you had a spouse at one point who died, and you are continuing to receive the RIF income from that spouse, then that income is also considered to be eligible pension income. And now that you're in a new spousal relationship, that is eligible, if you are under 65, to split over to your current spouse. Otherwise, you have to be age 65 or over for money that is in a RIF to qualify for this income splitting. So that includes the registered pension plan that we already mentioned, and it also includes then a draw from a RIF. And if you have a registered annuity that originally was RSP, that you've converted, that you've purchased annuity, that will then also qualify after age 65, but not before age 65. And then when you have this splitting over to the other spouse, not only do you split over the income to that person, but also the receiving spouse will be able to claim the pension credit. So just to explain why it is that this is beneficial to you, we have what's called a progressive income tax system, which means that we pay higher rates of tax on higher levels of income. If we have one person who earns a large amount of income, they will have gone up through tax brackets to get to whatever level of income they are. If you can split over to the other spouse, then the two of you will be taxed on your income and you will move up through brackets, but you'll move up through lower brackets together rather than one person who moves up through even higher brackets. So the splitting then allows us to reduce down the taxes for the household, and we have more usable money in the house as a result of that. The pension credit is a credit on the first $2,000 of income that you receive from these sources, eligible pension income. You get a lowest bracket tax break on that first $2,000. That's the federal amount, and then a similar type of tax credit on the provincial collection of taxes. So it can be worth somewhere between $300 and $500 of reduced taxes to each of you by being able to claim the pension credit. And I say $300 to $500. It depends on province. I don't have it memorized what happens specifically for Ontario, but it'll be at least $300 each that you'll get from using the pension credit, and so you double that up effectively by being able to split with the other. We also can make use of the TFSA room that we have available between the two of us to do some potential more tax efficient savings, shall we say. You cannot contribute directly into your spouse's TFSA like you can in creating a spousal RSP. But what you can do is you can give money to your spouse, and your spouse can put it into his or her own TFSA. That makes sure that each of us can make use of as much as possible of tax-free savings account room. Currently, the room is $6,500, as you see here. And so if it's not used by someone, then we're losing out on that ability to get the tax sheltered savings of the TFSA and then the tax sheltered or tax-free withdrawals from the TFSA. If we are going to make use of both of the spouses' TFSAs, then we can do this gifting that will take care of that. There is no attribution then of the income or the withdrawals, and the only concern about that would be if you're shifting money over to your spouse and then he or she is drawing it out, putting it somewhere else, and on an annual basis you're trying to use the TFSA as a shuttle to get more money into the hands of your spouse, and the TFSA is just the conduit for that, then potentially you could end up with some taxation that would bite you on that. Paul, you're back. I'm just wondering whether things are following adequately, or if you've got something you want to bring up.
No, there's a question. There's a couple questions already that we'll defer to later, but there was one that seemed timely from Robert, and thanks for asking about why would you not want to, or perhaps rather, under what circumstances would you not want to claim the maximum, the 50% for the pension income splitting?
It would depend on your income, your relative income brackets between the two of you. Usually, you would assume that you would be better off to do the full 50% over to the other spouse. But in some cases, it might be that you and you do get to make the decision every year. Just because you do 50% in 1 year, you're not locked in for the rest of your life. You can see what works most appropriately based on your income in that year, which may be different than either or any of the preceding years. So 50% you would assume would make most sense, because then you're levelizing between the two of you and again keeping underneath those bracket levels. But it could be that that because of your income, income brackets are ranges, and so it may not be necessary or desirable to have a full 50% going over to the other spouse, because one of the things that happens as you go up in income level is the receiving spouse might lose out on other tax breaks in some way. The one that comes to mind right away is the clawback on the age credit. So if you're entitled to the age credit, but you have more income, and this could be the lower income spouse, despite that you have the ability to income split and therefore reduce down the income tax that the lower income spouse will be directly subject to by pushing up even further that person's income. If they're in the range where the age credit is clawed back, then it might be better not to transfer over as much to that lower income spouse. And fortunately, both the tax professionals who prepare taxes and the software, they will do those calculations for you and suggest to you what might be the best proportion to make use of when that opportunity comes to make that election to split between the two of you. There's even some really odd situations where it can make sense to have a low income spouse transfer to a higher income spouse, and that's because the higher income spouse might be in a place where or the low income spouse might be really significantly losing out on those tax breaks, and by reducing that person's income to even lower level, there might be greater gains to be made on the tax credits that would be increased for that person, and the concession on the income being raised of the higher income spouse might be less than what the tax credits would be for the lower income spouse, which again is why it's nice that the software does those calculations and make those recommendations to you. Okay, well, I'm gonna move on and talk about attribution generally. So now what I'm talking about is not those registered accounts, either RSP, RIF, a combination, or tax-free savings account. I'm talking about non-registered, or the phrasing that sometimes use, open accounts or cash accounts, where you would like to be able to just say, all right, well, since I can transfer property, investable property from one person to another as a spouse, and I don't have any tax that applies on that transfer because it rolls over. If there was an existing capital gain on that, it has a base level cost and then it's increased in value. I'll just give it over to my lower income spouse and let him or her invest in that on a continuing basis, and taxes will then be in that person's hands. Well, it's not that easy. You can't just make a gift and end up in the hands of that person and it being taxable to them. This is the application of the attribution rules that can affect how the taxes end up back in the original spouse's hands. So if you give money to or property to the lower income spouse who invests that and makes passive or investment returns off of that, then the investment returns will be legally going to that recipient who now owns the investment dollars, but the tax on that invested amount is then attributed back to the original spouse. And it doesn't matter whether it is an outright gift that is made from the high to low income spouse, or if it's done in a roundabout way by guaranteeing a loan. Let's say the high income spouse is going to put his or her own credit worthiness on the table so that a lender will lend money to the lower income spouse. Well, if it's based on the higher income spouse's capability alone, then attribution will again apply. And similarly, if there's a guarantee that is given by the higher income spouse, attribution will still apply. And it also applies where you have some kind of an intermediate, rather than a direct one person to another transfer. If you use a trust or a corporation, those kinds of indirect transfers will also be captured in that way. So that's the attribution rule that applies for non-registered money. But there are some things we can do to try to work around that. The most commonly discussed way that you can do it is to set this thing up, instead of having it as a gift from one to the other, structure it as a loan from high income to low income spouse, and then the low income spouse invests that amount. Now, this has been a really useful strategy for at least a decade and a half now, or roughly a decade and a half, because the interest rate that is charged, and there must be interest that is charged on this, is dictated by tax regulations based on how the economy is operating. And over the last roughly 15 years, since about 2009, the required minimum rate to be charged by the high income spouse to the low income spouse, by the lender to the borrower spouse, it's been at 1%, or for the occasional quarter, it's adjusted every quarter, it's bubbled up to 2%. But as you know, we have had a significant change in interest rates and inflation that we're facing. So now the rate stands at 4% in, I have the figure down here for the first quarter. Well, of course, we're into the second quarter of the year now. The interest rate is not at 4%, it's at 5% now. So you can imagine, if the high income spouse lends the low income spouse, and there has to be a 5% interest payment that is income to the high income spouse, it's much more challenging to make this thing work in that way. So interest does have to be paid. It still can work, but perhaps not as effectively in this interest rate environment. And then basically what happens is the interest payments from the borrowing low income spouse are a deduction to the low income spouse, an income to the high income spouse, but then the investment returns off of the investment money are taxed to that lower income spouse. In order to make sure that this is treated as a loan rather than as a gift, you'll have to be able to prove that you have set it up in the first place and that you have had the interest payments actually being made between you. And so it's highly recommended that this be a written agreement that is put in place. And the interest payments, they have to be made during the course of the year or within 30 days of the end of the year. And that doesn't mean the end of January, which has 31 days. It means literally the 30th of January, the interest payments have to be made no later than that of the following year to which they are related. And otherwise, the loan will become offside and no longer be entitled to the interest rate in the quarter when it is established. And why that matters is because, as I said, over the last while, it's been a very low interest rate that has been required, 1%, maybe 2%, but now we're up to 5%. So if you go offside on the loan, then you're not entitled to that low rate when you established it, which you otherwise would be able to do for the life of the loan. You will then be into the current years when you go offside, which could be a higher interest rate. So that's not a good result for people who are trying to set these up. As I said, it's probably less likely that this is going to be an appealing way to go about things in the current interest rate environment now that we're up to 5% level currently. But there are still some other things that you can do in order to get around the attribution rules. One of the things that you can do is just have a fair market value exchange. Let's say that the lower income spouse owns a car that's worth $50,000, let's say. Then the high income spouse could effectively buy that off the lower income spouse. Here's $50,000 in cash. Let's change the ownership on the car, which was the lower income spouse's ownership. And now the car belongs to the higher income spouse. The $50,000 in cash belongs to lower income spouse, who can then invest that, and lower income spouse will be taxable on that. The other thing you can do is, if you have the inclination and the capability of setting up a business and earning business income, then there is no attribution on business income. Effectively, the money is being put at risk in an active way. It's not a passive portfolio, and therefore the income is not attributable back to the high income spouse one, as I'm showing here. Another way that you can do things, if you're not inclined to start up a business, which is if you're just trying to work around taxes, shouldn't be the driving force at all about whether to start a business. But one of the things that you can do is have the arrangement set up so that when there are investment returns, you are going to be subject to attribution on those returns in first instance. But if you can isolate the income amount on a year-to-year basis and put it over into a side account or a distinctive account from the original loan or gifted money, sorry, this is on a gift, you can take the returns and the investment returns on the returns, which is called second generation income. And second generation means anything after the first return that happened. There is no attribution on second generation income and onward from there. As time rolls on, it could very well be that second generation income, the reinvestment of investment returns, is as much or more than the original money which was gifted from one to the other. And then one other thing to touch on, because we are talking about spousal income splitting, but there may be children who you're looking at doing some kind of splitting with as well. If you make a gift to an adult child, then there is no attribution. But if you make a gift to a minor age child, and I don't mean any child, I mean your own or your grandchild, if you do that, then the attribution rules do apply to that on income. And when I say income, I mean interest or dividends, royalties, anything that is generated off the invested capital. But if the capital itself grows in value, capital gain, then capital gains are not attributable from a minor child over to a parent or, again, a grandparent. So that might be something that you would do if you are trying to invest for the benefit of your child, because it does have to actually be a gift of the money that is being invested for it to belong to that child and be taxable to that child. You may set up and set up the portfolio of investment leaning more significantly towards generating capital gains rather than those year-to-year income distributions that might come to you. So with children, you can also do some income splitting. Another way that you can split between spouses is with your Canada Pension Plan. And this may look like or sound like the same kind of thing as doing a pension income splitting, where you can do the 50% that I was talking about earlier, where you make the election on a year-to-year basis. But in this case, with Canada Pension Plan, what happens is it's not a one to the other, a one-way arrangement of splitting, and it's not something that you do on a year-to-year basis. What happens is once the two spouses are at least 60 years of age, you can split the credits that each have gained over the course of their lives because they have been contributors into the Canada Pension Plan. And when you do that, both of you, for the years that you've been together, contribute in your credits, which I'm putting down in little balls here, 2 on one side and 6 on the other. You put your balls into the hopper, and then there's a two-way sharing where the splitting is both of you putting your credits in and then each of you taking half out. And from that point forward, the payments that are made under your Canada Pension Plan will be either deposits, if they are direct deposits to your account, or checks that are sent to you. Those will happen on those monthly payments, split between the two of you, again, based on the time that you've been together. If you're high school sweethearts and you've been together from age 18 onwards, then you'll be able to split all of those things. If you're something less than that, then there's a calculation involved with the number of years that you have been together and then how much can be used for the splitting here. So it's a one-time, once-in-a-lifetime, effectively, choice that you make to split between the two of you, and not something as happens with the pension income splitting rules where you do it on a year-to-year basis. So for same reasons though, because we have a progressive income tax system, you'll be taxed at a lower tax bracket generally if you can shift over and equalize, levelize the income that the two are receiving, you are likely going to pay less tax between you, and it's going to come to the spending of the same couple or family when you do that. The last couple of points to touch on had to do with what you do with your day-to-day cash. So how you manage your household when you receive a gift from someone outside the relationship, or an inheritance is probably more often the way this might happen. The low-income spouse would be beneficial to the household, to the two of you, if a receipt by the low-income spouse was isolated from the general assets of the two of them, and in that way it can clearly be identified as belonging to the low-income spouse, and you won't confuse it with other assets that have been commingled, which may belong to one or the other or both. So when you have a gift or inheritance and you invest that money as a low-income spouse, then no attribution will apply on those amounts. The other thing that you can do just with the general money management of the house is, if the high-income spouse uses his or her assets to pay for household expenses, then that leaves more money elsewhere for the low-income spouse to invest. So good record keeping in these cases, and the good record keeping in most cases, you won't really likely ever have to prove it. But if you are called upon to do that, if you have significant non-registered income, then it may be one of those things that causes for you to come up on the screen of the CRA auditors or of their systems checking certain parts of the tax system where they might look into these things. And so you may have to show who had what components in order to not be subject to attributions. So the idea is to make sure that you can clearly show that low-income spouse invests his or her assets for income that is being recorded and being reported by that lower income person to then have more money available in the household. And then the last thing here about charitable giving is that I mentioned it earlier about charitable giving. The threshold for charitable giving for getting into higher tax credits is $200 donations in a year. So if you are going to have individuals, then each of you has to get to the 200 level. What the Canada Revenue Agency does as an administrative concession is that if you have donations that are made by either spouse, in the name of either spouse, they will allow for the other to claim all of those donations, so you break through that $200 level sooner. That $200 level, not being 400, means that you have a 15. I'll just use the federal amounts here, and there's the provincial credits as well. But you would have a $15 credit on the amount under 200, and then once you break over, you would have a 29% credit on the contributions above that. If you have to get all the way up to 400, then you're going to have only, because you have 200 each, then you're only going to get 15% credit on $400, but you'll get 29% on the amount over 200 if you combine the two together when you report your charitable giving. So that's again, a small amount that you get as additional, and maybe you take the gain from that and you make a further charitable contribution, but that's up to you. Then you're taking it away from tax dollars, either putting it in your own pocket or giving it to the charity that you care about. And then the last thing that I'll touch on is some estate planning considerations. I mentioned earlier that you can have rollovers between the spouses. With registered money, RSP and RIF money, the rollover can happen whether the person is named as the beneficiary on the particular plan, or if it is an entitlement that the surviving spouse has under the estate of the deceased. So there is a sufficient amount of estate claim gift from the will of the deceased person over to the survivor, so that the survivor can then receive that amount via the estate. Maybe the RSP or the RIF money was paid into the estate either intentionally or because there was just a miss in terms of having the beneficiary designation on the plan. As long as that money going into the estate then is sufficiently large to be captured by the amount of entitlement that the surviving spouse has out of the estate, then an election can be made to make sure that there's a rollover from one to the other. And then there's also the possibility with a RIF that the survivor is named as successor annuitant. And the difference between the successor annuitant and the named beneficiary is mainly on the Registered Retirement Income Fund, mainly that with the RIF beneficiary designation, the cash value of the plan is paid out to the survivor, who then can place that into his or her own RSP or RIF, depending on age. And with a successor annuitant, the plan, the contract with the financial provider remains in place, and then the survivor as successor annuitant is substituted in as the annuitant of the existing plan. So it's a little more streamlined if you do it by successor annuitant. With a tax-free savings account, similarly, you can have a direct beneficiary, a state beneficiary, or a successor holder, which again, similar concepts to what I just described for RSP and RIF. Only a spouse can be on a RIF, the successor annuitant, or with a TFSA, a successor holder. You can't name someone else where you have the continuation of the respective plan and carry on with that contract. If it is someone who is non-spouse, the administrator will not allow for that to happen. And then with the TFSA, one thing to remember about it is that though TFSA room rolls from one spouse to another, TFSA value rolls from one spouse to another and will continue to be TFSA, as in tax sheltered plan, without affecting the receiving spouse's own TFSA room or requiring TFSA room to continue as a TFSA. Where you have unused TFSA room, when a person dies with unused room, that doesn't go anywhere. It's just completely lost. So one of the things that if you have a terminal medical condition, there may be that you have an opportunity to look at how to rearrange the estate in a way in anticipation in a difficult situation, obviously, but to make sure that the survivor is as well taken care of as possible. You might want to contribute more into the TFSA of the person who is terminally ill, so there will be a larger rollover to the survivor, even if that extra contribution might be by taking out a small loan, a line of credit perhaps, would allow for the full amount of the rollover to come to the survivor. And then after the person's death, you could then pay off that line of credit amount, and the room would still be available to the survivor at that point. The last item here about capital and capital assets is, as I mentioned earlier, where you have spouses and you have assets that have a gain in value, then if you give to someone else, there's going to be a triggering of that capital gain. But you can transfer over to the survivor and, or not survivor, to the spouse, and it will automatically roll over to the other at the cost base, and you won't have a capital gain. Now, with all of these rollovers, there is the option to elect out of those rollovers. It may be that you don't want to have a full rollover of RIF money at the death of one person. If someone dies early in the year, let's say in the first couple of weeks of January, then a full rollover to the survivor will defer the RSP or the RIF taxation by going over to the survivor's spouse. But you may want to have some amount of that account taxable to that person because their year will have been only a couple of weeks long, and that would allow for the tax to be applied at low bracket rates, even not being taxed based on the basic personal credit, and then have the remainder, once there is a larger amount that goes up into higher bracket levels, rolled over to the surviving spouse. There may be reason with capital assets that you don't want to have a rollover from one spouse to another, again, because you are content that less tax will be paid by triggering the taxes going from one spouse to the other. You're able to do that. And then the last item I've got here is on life insurance. You can generally have a beneficiary named on life insurance, and you have the tax-free payment of life insurance to any beneficiary. There are some extra features, and I won't try to go into those at this point, but where you have spouse as beneficiary, you can get some creditor protection on the insurance ownership if you have spouse as beneficiary. And just generally, making use of life insurance between spouses can allow for the other to carry on, to manage well with the absence of the deceased. And you can do that in a tax efficient way between the two of you to make sure that large asset that comes on death comes into that person's hands in a tax effective way. I see Paul back on. I'll open it up and let Paul pick it up from here.
Yeah, just we have a few minutes left, Doug, and I know there's still some wrap up to do. So unfortunately, some of these questions might be in rapid fire, and if we don't get into great detail, we'd be happy to introduce you to one of our coaches to get into them in specific. So a question that hasn't been published yet around the TSA beneficiary. If the spouse was the successor holder, would that impact their contribution room if the account holder passed away and the money was transferred to the spouse?
No effect on their room. It would go to that survivor and would continue to TFSA, and the survivor's room would not be needed or affected by that. Okay.
A few other questions here as well, going back a little way, if that's all right. And I know you've got your summary page up here. The home buyer's plan, can that be, because that came up in the RSP, spousal RSP question, I think, can that be shared if one person only, how is that shared? I know that really it's coming out of an RSP, so there's only an individual owner of the RSP. Can the home buyer's plan process be shared between the spouses?
Yeah, you take it out of your RSP, and then you have to contribute it back into an RSP in the following 15 years. You have to contribute it back in. If you don't, then you get taxed on a proportion of it. So you're using it for the purpose of the purchase of the property, and then it has to, the repayments have to go back into your own RSP, and I guess that's an important part of it. You can't take money out of the RSP and contribute it into a spousal RSP. You can, however, and I'll stand to be corrected on this, Paul. Maybe put it to the coach to respond if anybody asks about it. You can, however, take money out of a spousal RSP and make the recontributions into an individual RSP. The 3-year window issue that I was going through does still apply if you potentially if you take that money out. So that's a little bit more of a convoluted application of the home buyer's plan, but there's some maneuvering.
We'd want to look at the attribution rules and who's the higher income spouse and all those kinds of things, I imagine, in those scenarios. Yeah. Okay. And this one was an interesting one. If your available RSP contribution room is 0, perhaps as an example, your pension adjustment precludes you from making an RSP contribution, can you still contribute to a spousal RSP, or is this perhaps where a loan situation might come into play?
Yeah, you wouldn't be able to make any RSP contributions if you have 0 contribution room. You may make a loan between spouses. That would be then non-registered money that you would be doing that with, which again has more complications involved with it. I know I had the pretty pictures of all the arrows there, but it is more complicated. So make sure that you have a good conversation with your coach about doing any of those kinds of maneuvering with non-registered money, whether it's a spousal loan or those other things like second generation income.
So then there's two questions we haven't got to. One was a basic question from the beginning about explaining a trust briefly, and I didn't ignore that question other than it isn't, while it has alignment to today's topic, it's a topic unto itself. And we certainly have resources on our website about what trusts are, and we'd be happy to speak with you about that individually. But I'm just wondering if you have a 30-second or less answer, Doug, on what is a trust.
Okay, so a trust is an ownership arrangement where you are breaking apart the legal title to certain property. And property does not necessarily mean real estate. It means anything that can be owned. You're breaking apart the legal ownership, putting that with a trustee who can manage the property, and then you've got someone else, and there could be more than one in both cases of trustee and beneficiaries. Someone else is the beneficiary who will get the benefit of the property involved. And you'll usually set it up if there's some frailty of the person involved who you feel cannot or should not own property outright directly. You can put a responsible trustee in place to make decisions about what to do with the property.
And I think it's fair to say trust rules have gotten a little bit more complicated in Canada over the past few years, the way they're taxed and different things. Some of those obvious advantages that may have existed in the past are a little less obvious today. Is that a fair statement?
Yeah, you generally don't set up trusts to try to get tax breaks. There are some concessions that are made with some trusts, particularly where there's a disability involved. You'll set them up so that you can protect against creditors or somebody who can't manage money adequately, and then you will pay attention to the tax implications of that, but you don't lead with trying to reduce down taxes. It's not the same world as it was about a decade or so ago.
And if you'll indulge me, one last question at 101, and then we'll wrap up. And thank you to everyone who's joining us on the call today. Question number 8 there, CPP credit sharing. When do you decide to do the CPP credit sharing? Is that always? Are there circumstances where that wouldn't make sense?
Yeah, the earliest you can do it is when both spouses are at least age 60, and so you would do it usually once the two of you have gotten to at least that age, and at least one of you is going to commence your CPP right at that point. That's usually what is the trigger to it.
Okay, well, perfect. Doug, I genuinely appreciate, as always, your contributions to our financial literacy and our financial resilience of our owners. You can see the summary of all the topics that Doug has touched on today. Again, this webinar will be available as a replay on our website if there is topics that you'd like to go back and review, and there will be some written handouts that we'll make sure our coaches get out to our attendees shortly after the call. Doug, thank you again for joining us, and thank you to everyone who joined us on the call. We appreciate you making time to be with us today. Most of our attendees lasted the full hour, and we hope you got some valuable information today that you can apply to yourself and your personal situation. On behalf of Doug and my Libro colleagues, I want to wish you a great day, and thank you for attending our seminar.